Hi, my name is May Zula, and I'm here to talk to you about financial math. And I'm going to tell you everything you need to know about 10 minutes. So pay close attention. Feel free to watch this again and again to learn more. Before I start, I just want to put my name up so you know who I am. My name is May Zula. I do have a blog on financial freedom, as well as did a webinar today on the 3 steps to creating a financially free life. So I'm just going to put my name and a link to that webinar up here in case you're interested in learning more. And maybe I won't just yet because it's not showing up. Okay, so let's take a look at the first link. So we're going to talk about different things that people who know about money understand, and the rest of the world, which is most people, don't really understand these terms. And it's not something to be scared of. You can find out what they mean. They're not that hard. However, I'm going to explain it so that you can understand. So the first one I want to talk to you about today is net worth. So let me go to a website right now and take a look at it with you so you can see what I'm talking about when I say net worth. So here we have this website, as you can see, and it lists the top 50 richest celebrities, and they're all talking about their net worth. Okay, so if you have a high net worth, that means you're very wealthy, and so that's how they calculate it. Well, what is net worth? Okay, so net worth, and here is a calculator that I brought up to kind of show you what net worth is. This is if you just Google net worth calculator, you can find things like this. What they do is they ask you questions, you put in all your answers, and they calculate your net worth. Basically, what they're asking you for is how much cash do you have, how much do you have in bank account, your retirement savings, your non-retirement investments, your accumulated cash value of your insurance policy. So they're asking you for all the money that you have, right? And then they ask you for the value of your home, I think is what they ask next. Okay, value of your home, value of other real estate, value of your cars, your automobiles, value of other personal property, any other assets that you have, like jewelry, stamps, coins. What is the value of those things? So basically, they're asking you, what do you own that's worth money, and how much is it worth? And then just list it. You know, I have $1,000 in cash. I have $50,000 in the bank. I have $100,000 in my retirement, and you just keep going on and on and on. And you just list all of the things that you have. So this page is not working anymore. That's fine. So let's go back to, I'm going to show you a different, since it's not working, I'm going to show you my spreadsheet just to kind of tell you. It's not really that complicated. You don't need to, it's nice to have something that asks you questions because you don't have to think too much. However, basically when you want to calculate net worth and you're looking at, my spreadsheet, I think. Okay. So in here you can just write out different numbers and calculate things with them. I'm using Excel. Okay, so net worth basically means your asset. I should probably put it here. So net worth equals asset minus liabilities. Now what is that, right? What does that mean? Assets is what you have. So that's like your car, the cash, the bank account, everything that you have. What is the value of that? Add it all together, and that's your asset. Liabilities excuse me. Excuse me. Liabilities are what you owe. So assets are what you have, liabilities are what you owe. So if you have a mortgage on your house, if you have a loan on your car, if you borrowed money from a friend, all of these things are liabilities. So you add up assets, you add up your liabilities. So say you have $100,000 in cash and retirement and everything. So you saved up $100,000. And say you owe $20,000 on your car. So then 100,000. So what would your net worth be? So your net worth would be 100,000 minus 20,000, right? And your net worth would be 80,000. So the people in that website are showing you they have net worth of 600 billion. That means that what they have is worth either 600 billion or more than that, and then they owe money, and if you subtract it, you get 600 billion. So that's how you get net worth. You can have a positive net worth. This is a positive net worth, 80,000. You could have a negative net worth. Say you have 100,000, however you owe a lot on yours, which is very common. Say you owe 220,000 in a mortgage on your house. So what'll happen is your net worth is going to be negative 120,000. Okay, so you can have a positive net worth, or you can have a negative net worth. The richer you are, the higher your net worth. At least that's how people measure money wealth. Okay. So that's net worth. I hope you understand what that means. So net worth is when you take your assets and you subtract your liabilities, and the number you get is your net worth. Assets is what you have, and liabilities are what you owe. And another word that might come up that you might want to know is liquid asset. Liquid asset means things you can use right away. So cash is a liquid asset. Bank accounts that you can access right away, those are liquid assets. Okay, things that are not liquid is a house. Okay, because you have to sell the house. So you don't have, I mean, the house is valuable, however, you're not able to just take the value right away. It's not liquid, it doesn't move quickly. Like a liquid will pour over and move around quickly. It's something that you have to sell to get the value. So a house is not a liquid asset. Cash is a liquid asset. Bank accounts are liquid assets. Investment accounts are liquid assets. So that's what they mean when they talk about liquid assets. Okay, so that's net worth. The next thing I'm going to tell you about is interest rate. Interest rate, APR. Okay, so say you go and get a loan from the bank and you want to borrow money to pay off your credit cards. Or maybe we'll talk about your credit card. Say you have a credit card that's 8.9%. Okay, so you have a credit card that's 8.9%. What that is an annualized percentage rate. No. It's an interest rate. Okay, 8.9% is an interest rate. So they're going to charge your money. They're gonna charge you interest, right? So when you don't pay off your credit card, they charge you interest, right? Now this is the part where people don't understand. How do they calculate the interest that you pay? Okay. Say you owe $1,000 on your credit card. $1,000 is how much you owe on your credit card. You didn't pay the balance off, so now you owe 8.9% on that $1,000. Okay, and that was $1,000 the whole time. It never changed. It was just always $1,000. Maybe, and then your payment was automatically deducted. However, for that month, the balance was $1,000 every day. So what they do is they take $1,000 and then they figure out what 8.9% of that is. So you take 1,000 and you find out what 8.9% is that. So to find out, you would multiply by 0.089. Okay, so when you have a percent, if you want to turn it into a regular number, you just move the decimal over 2 places. Okay, 1, 2. So that's how I got 0.089. I took this percent and I moved the decimal over 2 places. Now, after I went past the 8, there was nothing, so I put in a 0, right? So another 4. So if I take 1,000 and multiply 0.089, I get 8.9%. That's $89. Now, they're not going to charge me $89 on my credit card bill. Why not? Because that is based on an annual percentage. Okay, it's not. This is not It's an annual percentage, it's not a monthly percentage. See, so what they do is they take that 89 and they divide it by 12, and that would be the interest you would pay. So it would be, you take the interest that you would pay for the whole year if you kept this balance all year long, 1,000. Then you would be paying $89 that year in interest. The whole year your balance was 1,000, then your payment for that whole year would be $89. Now, they're collecting money every month though, right? Not every year. So they're going to take that amount, that projected amount that you owe, they divide it by 12, and that's the number of months, right? That'll give you the amount of interest that you will have to pay that month, $7.41. Now, if you pay down your credit card, okay, so you pay down your credit card to 500, and then the next cycle comes around, and it's always been 500 that whole month. So we do the same thing. We take 500 and we multiply it by 0.089, and that will give you the interest, which will be half of this one. However, they're not going to charge you $45.05 because that's for the whole year. They're going to divide that number. They're going to take that number and they're going to divide it by 12. You divide it by 12, and then you get 3.71 cents per month in interest. Okay, so they're going to bill $3.70. So that's how interest works. Now, sometimes annual percentage rate and interest aren't the same. Why is that? Say you had a late payment. Okay, so let's go back to this $1,000. Say you owe $1,000 all year long. However, you had a couple late payments, and each late payment cost $35. Maybe you had two, so you have $70 in late payment. Okay, so if you add 70 plus 80, you're going to get a different number, right? So I'm just going to add these two. These spreadsheets are fun. $159. So $159 is more than 8.9% because $89 is 8.9%. So $159 is 15.9%. So your annual percentage rate on the credit card is actually 15%. And the reason is because they include fees. They include all costs of your credit, not just the interest. They include any fees that you incur, anything like that becomes part of the APR. And that's to help us help people understand how much is your credit really costing you. Okay, so borrowing that money that you did on your credit card right now, $1,000, it's costing you $159 a year so far in that year. So then you have an idea. Wow, that's 15%. Wow, that's really bad. You know, 15% is kind of high. I don't want to pay 15% interest. So that's what interest rate is. I hope that was helpful to you. Finally, I'm going to talk about amortization. Now, amortization is a really weird word. Mort means death. So let's take a look. Amortization means like means death in French. So basically, you owe money till you die, kind of. Amortization is a really fancy word for saying how are you going to pay back your mortgage loan. Okay, so if you go borrow money to buy a house, you have a mortgage. A mortgage is a loan from a bank or another vendor to help you buy your house, and then you pay that loan back. And the payments, they amortize the payment. So I put in an example already, $100,000, you're going to do 12 payments per year, which means you're going to pay once a month. The interest rate is 6%, and the number of regular payments is 360, means 30 years. Okay, that's 30 years of payment. 12 times 30 is 360. And so you want to see and I think it auto-calculated that number. And then what I did was I clicked on this and then calculate. Okay? So when you do that, and you can find this online, by the way. This website happens to be brettwhistle.net, I guess is what this one is covered. I just Googled amortization calculator and found it. So you put in the information, how much you're going to owe, the interest rate, how many payments you're going to have. And then what happens is they pump out this nice summary of what happened, and they have a chart of how much you're going to pay each month and in principal. Principal is the actual loan. Interest is, you know, the extra that you have to pay for the price of borrowing a loan. And then this one is taking the principal and it keeps running at a running total of it as it go down. And this keeps the interest and does a running total. So as you can see, in the first year, all you paid off your loan was $105.16, even though you made a ton of payments, and each payment was $199.05. You only paid off $105.16 principal, and the total interest you paid that year was the total interest you paid that year. Okay, never mind. Sorry. This is the total principal. Okay, here, total principal is $1,228, and the total interest you paid was $5,966.60. Now you might be looking at that and saying, "Wait a minute, that is high. You know, $5,966.60. That is a lot of interest to pay on my mortgage, especially when I'm only paying $1,228 in my principal." So this chart, these calculators on the internet, they help you show exactly what is happening with the money. The interesting thing about mortgages is oftentimes you pay more, you almost double what you pay for the home. So what I mean is, say you bought the house for $215,838.52. Well, after 30 years, you're gonna pay back the $215,838.53, pay back that. However, you also pay back $115,838.53 in interest. You see, so you paid back the principal. However, you also paid back a lot of interest. In fact, that's more than half the cost of what you bought. Now, if you were to sell this house after 30 years, and if it goes to the same price or just a little bit above or below, you would have lost $100,000 because you paid that much in interest. To make a profit, you have to sell the house for more than $100,000 combined, because that's how much it costs you to buy the house. So that's amortization. I've seen amortization where it's like double. The interest they paid was over the price of the house, greater than the price of the house. So be wary of when you borrow money, that you understand all the math behind it, and that they usually will show you one of these amortization calculate like tables. You can see where your payments are going and how much you're actually spending. So that's what amortization is. It's just a way of breaking down payments so that you can pay for a longer period of time. And in this case, it's 30 years. For 360 payments is how they say it. So after 360 payments, you'll have paid off your mortgage. And that, in effect, is 30 years. Okay, so you can just go to these websites and check out these tools. You can use, if you have a spreadsheet, you can use that. It's a lot easier for me to use spreadsheets. And I hope that was helpful for you. So we covered net worth, which is what you have minus what you owe. What you have is called assets. What you owe is called liability. There's also liquid assets, which is cash, bank accounts, investment accounts. And then there's assets that are not liquid, like a house, which you have to sell before you can get any money from it. So it's liquid. You're not able to get the money back. It takes a while to get money. So you have liquid assets and non-liquid assets, and you have net worth. Second thing I covered was interest rate, right? What is an interest rate? How do you calculate an interest rate? Interest rate is on usually it'll tell you. A lot of them are on an annual basis, which means the interest calculated that month. They take the average balance, or they have different ways banks do it. It might be the average balance for that month. They take that average balance, multiply it by the interest, then they take that total interest and divide it by 12, and that's the interest you have to pay with each of your credit cards. Okay. So, and then any percentage rate is something else where if, say you apply for a mortgage and you get your mortgage, and then there's all these fees on top of it, right? They had to pay for the appraisal fee, they had to pay the title search fee, and all kinds of fees. What happens is you have to pay for those fees, and then your annual percentage rate goes up because you're paying more for the cost of your credit. So that includes things like fees to calculate APR. The last thing I went over was just amortization, which I just use a calculator on the internet. I just type in mortgage or just amortization schedule calculator. It's kind of a hard word to remember, amortization. However, that's what it's called. And you can find them everywhere. They're all over the internet. It's really easy to find that. And then you can understand what would go on if you bought a house. How much interest would I pay? How much principal? And you can find out, like, oh, so if I got a house, in the beginning, all you're doing is paying the bank. You're just paying the bank. And then after a while, you finally start paying yourself the principal. And then after that, who knows, you might, you pay off your loan. So that's it. This is Financial Math with me, Dula. If you have any questions, feel free to email me. I am at maydula@gmail.com. I would have shown you my toolbox, however, it doesn't seem to be working right now. So anyway, go ahead and explore these terms for yourself on the internet, play around, and get to know and understand financial math. This is important, and it will help you become smarter and wealthier person. Aloha.